Consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
We have the reality of living with the 5% Fed funds rate, with earnings that are still far too high and need to come down, the economy that's going to continue to slow down even further than where it is now. And we're going to be living with QT, not only here in the U.S., $1 trillion over the course of a year, but also in Europe.
The latest Consumer Price Index, or CPI, indicates that inflation is subsiding, coming in at 7.1% to 7.7%. In response to the declining inflation rate, the Fed is still increasing its interest rate, but at a lower pace. The latest Fed rate increased by 50 basis points against the 75 basis points we were getting used to. Economist and investment banker Jim Rickards predicts that 2023 would be a tough year, as he expects the economy to slip into a recession. As for cryptocurrencies, Jim is certain that they're on the path to fail. Let's listen to him.
So here's the Fed trying to deal with inflation, but they're dealing with it from the supply side. The Fed doesn't drill for oil. They don't drive trucks. They don't grow crops. They don't have farms, etc. The Fed can't do anything about supply side inflation except destroy demand. But here's the question: how much demand do you have to destroy to control inflation coming from the supply side? The answer is a lot. They're trying to get to a terminal rate. They're already there. They just don't know it. They'll be the last to know. So they're going to take rates to 5.25 or higher by March. But they're already at the terminal rate. They just don't know it. And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think. A couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. In deflation, it could be even with a very low nominal yield, it can have a much higher real yield in a world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse than 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. By the way, the person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains.
After the announcement that the Fed would be increasing interest rates by 0.5%, the markets responded with a sharp dip, not just in Wall Street, but even European stock markets. This rate hike would be the 7th successive rate elevation this year. Investors are becoming concerned with the hikes, as it's indicative that the Federal Reserve is willing to risk a recession in order to bring inflation under control. All stock benchmarks plunged, with the Dow Jones Industrial Average taking a 2.2% dive, the Nasdaq Composite shaving 3.2%, and the S&P 500 losing 99.57 points. About 90% of stocks ended the day in the red. Currently, the federal funds rate stands at the highest level it's been in the last 15 years, at a range of 4.25% to 4.5%. And this isn't even the worst news. Fed policymakers forecast that interest rates would go up even further in 2023 and could reach 5% to 5.25%. With the current progression, 2023 seems destined for even more economic hardships than what was experienced in 2022. Inflation currently stands at an extremely high 7.1% year-on-year, an indication that the fight against inflation is slow. Powell, in his latest speech, said interest rate hikes should be expected in the coming year. According to independent estimates, 17 out of 19 Federal Reserve officials on the Monetary Policy Committee believe that the Fed's target interest rates will rise above 5% in 2023. Jim believes having cash is the best hedge in 2023. Due to its low volatility, cash is better than stocks or most other assets. Since May 2002, the US dollar index, a measure of the dollar against the British pound, euro, Swiss franc, Japanese yen, Canadian dollar and Swedish krona, has soared nearly 13% this year. The US dollar is currently at a 20-year high, and it doesn't seem to be slowing down. Investors such as Warren Buffett rely on having cash to seize investment opportunities anytime they present themselves. Jim thinks this is what everyone should be doing as well.
Eventually, no, it'll be around for a while, and it might, outperform some of the other cryptos. But I'm struck by the fact that I go back to the Gertzer-Stein theory. There's no there. And what's interesting about the last 5 years, and by the way, I say things like this, Danielle, and people go, "Oh, Jim Rickards, he's a dinosaur. He doesn't understand technology." It's nonsense. I read, Satoshi Nakamoto's paper. Within months of its coming out, I've been in, gold, Bitcoin debates since 2010. I actually know a lot about it, which kind of brings me to my point, which is with nothing in the center, they replicated the entire structure of Wall Street. So you have exchanges, custodians, futures, options, settlement, clearance, lending, yields, etc. This whole Wall Street infrastructure, financial infrastructure, around nothing. I mean, Tesla stock, for example, maybe you like Tesla, maybe you don't. That's an individual choice. But at least they make cars. There's a real car there. And even intangibles, insurance companies provide services. There's something there. In crypto, there's nothing there. But they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange or you own a lender set. Now, that's all imploding. It's kind of a replay of 2008, except instead of, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and, Morgan Stanley was hanging by a thread, it's, FTX most prominently, but Genesis is kind of considering bankruptcy, et cetera. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, Danielle, I mean, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino and put my money on the roulette table and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but, in stages. But what's collapsing right now is the infrastructure.
Jim gives a grim prediction for crypto. He says without the exchanges, cryptocurrencies lose their value. Crypto exchanges have added value to the crypto tokens, but these exchanges have been suffering several issues, especially due to the lack of integrity of the exchange managers. The latest casualty is the FTT token, which suffered a catastrophic collapse after its exchange, FTX, failed. Many experts predict that more crypto tokens would fail in 2023 because they do not serve any viable need. But what about you guys? Will you be investing in cryptocurrencies in 2023? If yes, let us know why in the comments section below. Remember to smash the like button and subscribe to the channel to get more updates just like this one on crypto and finance.